There are two ways that you can make money in the stock market. Up first is exiting your investment at a better price, and generally that's selling at a higher price. Now, the second way that you can make money is by receiving dividends or other direct returns of capital. If you're trading in the short term, you're not receiving dividends or other direct capital returns. Instead, your only hope of a positive return is selling your stake to other investors for more. And this is where greater fool theory can lend a hand. Greater fool theory states that the underlying value doesn't really matter. And when you buy anything without looking at the price relative to the value, you're a fool. Of course, on occasion you can get lucky, but here's the kicker. You must often hope that there's a greater fool to buy from you at a higher price later on. Greater fool theory helps to explain how bubbles can grow, like the tulip mania back in the 1600s, or more recently, the housing bubble. Now, not all short-term trading really fits into greater fool theory, but the idea still lends a hand. The big takeaway is that in the short term, there's no direct underlying return of value. There are only hopes of a better exit price. In the short term, In the short term, the only transaction is between the buyer and the seller. There's always someone else on the other end of a trade, and sometimes people forget that. Money changes hands based upon their agreed upon price. This is why short-term trading is a zero-sum game, although it gets even a little worse than that. Throughout most of recent history, brokers charged an arm and a leg for trading, and those fees make short-term trading less than a zero-sum game. When you enter a trade, you're already down on the position. That's thanks to that trading fee. Back in the 1980s, brokers would regularly charge $40 to $50 just to make a simple stock trade. Now, technology really has helped level the playing field to all of our benefit. Many brokers now offer free trading today. Still, there are less obvious costs that are involved when buying and selling stocks. Also, there are still contract fees for derivatives like options, etc. But based on an asset's liquidity, you might pay a bigger piece of a wider bid-ask spread. This is one of many overlooked trading costs. So I hope it's clear that short-term trading today is still slightly worse than a zero-sum game. Over the long run is where real value is added and eventually passed on to investors. Some research points to dividends being the major source of stock market returns over the long run. Depending on the time frame, a few decades to a century, I've seen dividends contribute anywhere from 50 to 90% of total stock market returns. There's plenty of back and forth online as to exactly how much dividends contribute, but I'm not really going to split hairs. The big take... Alright, sorry, I'm back. A bee was attacking me. One trade-off to being in nature, I love it, but sorry, back on topic. Alright, so I was saying I'm not going to split hairs over how much dividends actually contribute. The big takeaway is that they're really important over the long term for returning value. That's why I'm personally a long-term dividend investor. Also, Uncle Sam taxes long-term capital gains at a lower rate, so that's an added benefit. These reasons are why I focus on finding undervalued dividend-paying companies, or at least companies that I think will eventually start paying dividends. Like my fairly recent investment in Facebook. I'll go ahead and leave a link to, or down in the comments below, I'll leave a link to why I invested in Facebook. And also, similar to Warren Buffett, my favorite holding period is forever. I like to find companies that I don't have to actively trade. I can just buy in and then see larger returns of capital over time. With all this said, I still admit that some people can profit from short-term trading. Some strategies have been shown to fairly consistently be successful. Although, based on my decade plus of research and direct investing experiences, as well as passing CFA exams, getting a finance degree, etc., I just generally plan on staying away from short-term trading. And one little caveat, that's unless I'm hedging certain positions or I'm making tax-advantaged moves. Do you have any thoughts on short-term versus long-term trading? Or really any useful insight to share? I'd love to hear. hear from you, just go ahead and drop a comment down below. And while you're down there, I'd really appreciate it if you just tap the like button as well as subscribe. But either way, thanks for watching.